All right, welcome back. Let's continue on to basically market valuation using price and enterprise value multiples. All right, let's jump into this. The rationale for using price to sales. So when we're looking at price to sales, it's most useful for distressed firms because revenue is always positive. And so what we have is remember with PE, with negative earnings, the PE ratio is meaningless if that number is negative. Also a reason why we would then go to earnings to price. But with price to sales, it typically is also generally more stable and less prone to distortions than earnings per share. The reason why is you have EPS from an accounting standpoint is still prone to management estimates, accounting policies, so on and so forth. So price to sales typically is also more useful in mature and also cyclical and zero income stocks due to the potential for negative earnings. Now, differences in price to sales ratios may be related to differences in long run average returns, but sometimes in the short term, sales doesn't necessarily mean, if you have a huge amount of growth in sales, doesn't necessarily mean that you're going to have positive earnings. Now, drawbacks, like I said, high sales growth does not translate into operating profitability. So price to sales ratio does not capture different cost structures between firms, right? And other things, revenue recognition, like I said, for accounting issues, can distort reported sales and forecasts, meaning depending on how the revenues are accrual-based versus cash-based earnings, or let's say you're doing completed contract versus percentage of completion when that revenue, when you actually recognize the actual sales. So let's take a look at the market price to sales ratio, right? So it's essentially the market value of the equity divided by total sales, all right? Or market price per share divided by sales per share. Now, if we look at the justified price to sales based off of fundamental factors, you'll notice that this is also still some complex algebra that we kind of get to. You can also see, you can almost still see the Gordon growth model here. Because remember, this is your payout ratio. This is 1 plus G. If you multiply both sides by sales, you essentially are left with what? EPS times the payout plus the growth. And you know that is actually what? Equals what? Dividend sub 1 if you multiply the other side by sales. So it's still just an algebraic permutation of the Gordon growth model. And you'll also notice that net margin times the trailing PE will also get you price to sales. Because notice, profit margin is EPS over sales, and your PE is price over earnings. So just a real simple multiplication through, you'll notice that if I do PE, you'll notice what both of these cancel out, and what am I left with? I am left with what? Price to sales. And that's why when you multiply net margin times the trailing PE, you end up with your price to sales number. When you're doing valuation using comparables for price to sales, it's the same method as price to earnings and price to book. You're looking for comparables and taking perhaps the average or median. If there is a low price to sales, it is essentially undervalued, going in the same direction as PE and price to book. Now, if you think about all of these multiples that when you are actually doing these comparative analysis, a lot of times analysts will do is they'll take the average of all of these multiples, right? So if I take the average of all of these multiples and I look at all of the companies within the industry, so if I were, well, let's say I was looking at airlines. If I look at United, I look at American, I look at Delta, and I have all of the numbers down, and I basically see their PE, the price to book, price to sales, and when I put them in, let's say, an Excel spreadsheet, or I look in column, you'll notice that some of them will all line up. They'll look really close to each other. Some of them will look completely off, meaning they're wildly different among the companies within that sector, or they're all within the kind of same range. In that case, you'll notice that that means that the market is essentially pricing based off of that particular multiple. So what you're going to do is pick the ones that basically where the industry looks like they're going to be in the same line, fairly close to each other. Now, keep in mind, there's also going to be ones that are outliers and outside there. Perhaps you would remove them, or you either take the median value, and which we'll see later, looking at harmonic mean as a way to kind of deal with these issues. All right. So, other ways that we're using comparables, we're using trailing sales to calculate. All right. In choosing comparables, you're going to try to control for the profit margin, the expected growth, and the risk and the quality of the accounting data when you're looking at other companies to basically pick to create kind of the comparable to price to sales. What is the comparable company? What is their profit margin? Is it similar? What is the expected growth of the other companies? What is the risk of the other companies? And obviously, you want to pick ones that have more sound accounting data. So rationale, cutting over to looking at price to cash flows. All right, sales, one of the items are harder to distort, whereas cash flow is also difficult to manipulate, more so than EPS, earnings per share. And cash flow is also more stable than earnings. And it also addresses the quality of earnings issue, whether if you have a high accrual-based earnings, and any of the issues associated with the accounting, meaning if there's any differentials in aggressive accounting treatments or aggressive estimates. And the difference in price to cash flow, differences in price to cash flow may also explain differences in long-run average returns as well. The drawbacks, though, of using price to cash flow, basically earnings plus non-cash charges approach and ignores some cash flows. And mainly we saw these. We saw them in free cash flow to equity and free cash flow to the firm. And mainly was what? The net fixed investments and working capital and net borrowings. We saw these in the formulas. And this is why free cash flow to equity is more preferable to cash flow from just operations, because it doesn't have the cash flow truly available, let's say, to the equity holders, because we're not factoring in the capital expenditures, and we're not factoring the changes in working capital or the additional funds or less funds that is available due to borrowing. All right? And keep in mind, one of the what they won't also show is the negative impacts with large what? Capital expenditures, right? The net capital expenditures. This may cause free cash flow to equity to go negative if they're buying a large, let's say a building or a very large expensive property, plant, and equipment and spending a lot on fixed assets. So looking at the ratio, you have price to cash flow. So pretty straightforward. You have the market value, the equity, divided by the total cash flow, or the market price per share divided by the total the cash flow per share. So what is just cash flow? So traditional cash flow is basically net income plus any non-cash charges. Or we could also say that it is cash flow from operations. Another way to look at it is adjusted cash flow from operations that adds back interest times 1 minus the tax rate. Or you can use EBITDA, but we'll see in a second the more logical more logical ratio is actually enterprise to EBITDA value, and we'll explain why that's more so. And then theoretically is more superior, being free cash flow to equity, because it does factor in the changes in working capital, the changes in net capital expenditures, and the changes in net borrowing. So there's kind of really 4 main ways we kind of define cash flow. The traditional way, where it's just net income plus non-cash charges, or you use cash flow from operations, or the adjusted cash flow, or using EBITDA. And then total, in what we saw in previous lessons, then we have free cash flow to equity. So cash flow definitions, when free cash flow to the equity concept, is probably the closest relationship to theory. However, the downside is the volatility to the capital expenditure. If the company is growing and buying an extreme amount of fixed assets, this potentially creates negative free cash flow to equity. Now, EBITDA is a pre-tax, pre-interest, pre-investment in working capital, and pre-investment in fixed assets. So it doesn't factor in the change in working capital, doesn't factor in the change in net capital expenditures, but it takes out the interest and takes out the tax. Basically, it's appropriate for the firm, but not the equity. Because why? Because it doesn't include the interest piece, because that cash that is not pulled out, because EBITDA is before interest, that's not available to the equity holder. So if we're going to use EBITDA, we got to look at the firm as a whole, because we're saying that the interest is available. So give me a two-step process for the justified price to kind of cash flow. We can calculate the stock value uses sustainable discounted cash flow model. This should look kind of a review of what we've seen, that you can calculate using the free cash flow to equity, very similar to the Gordon growth model, just substituting, instead of using dividend, we use free cash flow to equity. And then we divide the result. So notice I take the value and I divide that by cash flow. This basically helps me with a justified price to cash flow ratio, right? Now, keep in mind, this is a process in which we are creating almost a fundamental justified value versus as opposed to going out in the marketplace and seeing what other companies their ratio looks like, or a comparable model. So for the fundamental factors that are affecting justified price to cash flow, the justified price to cash flow will increase if everything else being equal. If you notice, if cash flow increases, growth rate increases, required rate of return decreases, and it's essentially the same relationship of all other ratios. Now, make sure that you understand. Remember on the previous slide that value, or how we say price, over cash flow. Remember this particular value. How did we calculate that? We used what? Free cash flow to equity over 1 plus G over R minus G. Sometimes people say, well, if cash flow is increasing, doesn't that make the multiple go down? No, we're talking about the justified one where we're calculating the value. So if this actual cash flow is going up, notice what's happening to the numerator. It is also going up. As the growth rate is going up, notice even if if growth rate is going up, the denominator is becoming smaller. The whole fraction starts to become higher, and the entire fraction is otherwise going up. Now, if the required rate of return decreases, notice then also the whole fraction goes up, and the numerator to the justified ratio then also goes up. So same relationship, but just wanted to kind of link that to the previous slide. When we're looking at valuation now, looking for comparables, it's the same method as price to earnings, price to book, price to sales. A low price to cash flow is undervalued when you take all the comparables. Now, we're not talking about justified, we're talking about comparables. We take all of the comparable companies and we get a value of what generally companies within that particular industry, what is their price to cash flow. If the company I'm looking at has a essentially lower price to cash flow, then it potentially may be undervalued. This is the same relationship as we would see in price to earnings, price to book, and price to sales. All right? So things that you need to control for, though, if it's lower, make sure that, what is the risk and return characteristics, right? So is there a reason why it's lower? Control for any cash flow, and control for the growth rate. What are some of the things that actually maybe there is a reason why it's lower, because its growth rate, people don't anticipate the growth rate to be high as the other comparables. So make sure that the undervalued part of it is not actually, the price to cash flow may be justified for the lower price to cash flow after you control for these. Now, after you make your adjustments for those, and it is still below kind of the industry average, then sure, it may be undervalued. So, looking at price to EBITDA or enterprise value to EBITDA. Now, we briefly touched upon this, given that EBITDA does not have the interest component in there. Now, keep in mind, since we are saying that pre-interest, that cash associated with the interest being available to equity holders, which is not really appropriate. So think about it. EBITDA is the earnings flow for both what? Debt and equity holders because it's pre-interest, right? A multiple using total company value, enterprise value, in the numerator is logically more appropriate than market price, given the market price of the stock is essentially the equity, and that interest, the cash before interest, is not available to them. So because the numerator is enterprise value, EBITDA is a valuation indicator of the entire company, including both debt to equity. So let's take a look at what is the enterprise to EBITDA ratio and what is enterprise value. It is the market value of the common stock, market value of the debt, market value of the preferred, subtracting out the cash and any liquid investments, because if another company were to buy the entire firm, that purchase price would actually be reduced by the amount of cash or liquid investments that company is holding. Because if I'm buying the company, and let's say if I'm buying a company that's half of it's all cash, guess what? I'm putting in cash and I'm getting cash back. So I'm controlling for that, removing the cash investments, and that's the kind of logic behind that, because you're buying the company for cash and there is cash inside. So EBITDA, we covered this before, but just to review, earnings before interest, taxes, depreciation, and amortization, provides basically how of the firm's value of the entire firm, and not just the equity, because it's both debt and equity, because being before interest. So why would we use enterprise value to EBITDA? So comparing firms with different financial leverage, since EBITDA is pre-interest, right? Given if the different levels of financial leverage, this allows to control for large differentials in interest, and it controls for what? Depreciation and amortization, which are non-cash charges. This is pre-depreciation and amortization. And one of the biggest reasons is EBITDA is typically usually positive when EPS is negative because of the depreciation and amortization, because of the interest and taxes. Those are not pulled out. So it's the earnings before you take out those particular items. Now, some of the major drawbacks, we've seen this in free cash flow to equity, free cash flow to the firm, just hammering it some more. Basically, it ignores changes in working capital investments. And free cash flow to the firm also, which controls for net capital expenditures, is more closely tied to value. Remember when we went over free cash flow to the firm, is mostly appropriate for unstable or very leveraged firms with a lot more debt. So this kind of controls for the two things that are actually missing, which are essentially changes in working capital investments and changes in net capital expenditures. All right, so valuation using enterprise value to EBITDA ratio. It's going to be very similar to your other ratios as well. If your firm's enterprise value to EBITDA is less than the benchmark, meaning overall the other companies within the industry, that would mean it could potentially be undervalued. If the firm's enterprise value to EBITDA is greater than the benchmark, meaning the other companies within the industry, it potentially may be overvalued. Now, critical things to just kind of remember, that enterprise value to EBITDA, why are some of the reasons why I would use it? Earnings may be negative. There's a higher chance that EBITDA is positive. And secondly, the main point that you have to understand is that enterprise value to EBITDA, we're looking at the entire firm, not just the equity. All right, let's jump forward. So what about dividend yield? So arguments for using dividend yield. So dividend yield is just dividend divided by price. just looking at the yield, how much cash flow that I'm getting from dividend over what I'm actually paying for in a price, it's a component of, let's say, total return. And why would we use it? It's a less risky component of total return than, let's say, capital appreciation, the actual increase in price, right? So the market dividend yield, so the trailing dividend yield is the 4 most recent quarterly dividends divided by the market price. The leading is basically the 4 forecasted dividends, next 4 quarters, divided by the market price. So for essentially practical purposes, dividend yield is preferred over price to dividends. Because why? Because if it's a growth company and it pays no dividends, you can't have a 0 in the denominator. It kind of makes the ratio then becomes meaningless and becomes a problem. So the justified dividend yield, as far as from a Gordon growth model, and once again, this is also just algebra. We're not going to run through the algebra on this, but it basically is an algebraic solve for that. This is your equation for from a Gordon growth model. You notice it's R minus G, 1 plus G. If you really think about it and you want to, it's just basically flipped upside down per se. Because if you just reverse the equation, if you flipped and took the reciprocal of the fraction, this formula really starts to look familiar. So what are some of the fundamental factors affecting dividend yield? It increases as required return increases. So let's take a look at, remember the equation on the previous page. What do we have? So dividend over price equals R minus G over 1 plus G. So as required return increases, what ends up happening? So if required return increases, notice what happens to the dividend yield. It also increases, right? What else? So high growth rate decreases the firm's payout, and therefore the firm is less able to pay dividends. So very high growth rate. Notice as this growth rate goes up, what happens to the entire fraction? It starts to come down. So as the growth rate becomes smaller on the flip side, so if growth rate were to fall, then notice the fraction starts to essentially increase. All right? Now, other things, high dividend yield strategy equals basically a value strategy. All right? Really, if you really think about, right, dividend paying stocks, if high growth stocks, when they pay a dividend, think about what it signals to essentially to the market, right? If I'm a very high growth stock and you're investing for the purpose of growing, and I can you a dividend, I'm essentially saying, here's your money back. I can't give you additional return on this. Now, if I'm a growth stock and I want that perception, I essentially will do what? I will essentially hold that cash and hopefully find projects that I can get more earnings off of. So it's a very much of a value strategy when you're looking at dividends. So just think about that concept. And just to kind of put a little point to it, if you actually, just from a concept perspective, to think about kind of generally the dividends, if you look at, let's say, some of the largest hedge funds in the world, so let's take Bridgewater Capital, for instance, I think they have assets over $80 billion, right? It was huge. So if you put that in perspective, so $80 billion is a really big hedge fund. Now, if you look at Apple's balance sheet, most people don't know, they have most recently, let's say, over $170 billion in marketable securities on their balance sheet. That's over double the largest hedge fund in the United States. Why don't they pay that out in dividend? Over 170 billion is a lot of cash there. So why? Because when typically people are investing in Apple, they're thinking what? That they're mostly a growth stock. So think about as far as you go further in the curriculum, and I'm just planting the seed here on how kind of this dividend policy, and this is why these things are going to kind of be like value strategies when you're talking about dividend yield. So let's take a look. So valuation using comparables. All right. So what we're seeing here is notice that the dividend yield here, 8%. We want a high dividend yield. And what about beta? So beta, remember, is a measure of risk in terms of the market. We want a low beta, right? So that's actually, so SW Utilities is looking pretty good. And in fact, its growth rate is higher. So it's winning on all fronts, right? It's basically SW Utilities is definitely preferred. It's a lower risk. It's higher total expected return. And it's basically beating NE Utilities in all aspects. It's essentially, in terms of how Charlie Sheen, it's winning, all right? So this one is definitely the more preferred one, given that it has a higher dividend yield, a lower beta, and the growth rate is much, much higher. So taking a look at like cross-border valuation differences, if you compare companies across countries, there's going to be different accounting method differences. Like LIFO accounting doesn't exist under IFRS, and we talked about research and development costs, where IFRS can capitalize those development costs. There's also cultural differences, economic differences. This can cause the multiples and the ratios to kind of be very, very different across countries. So, like an example, individual companies in actually the same industry in different countries can have very, very different PE ratios. Now, we can also look at what's called momentum indicators. Momentum indicators are based off of price, such as the relative strength indicator, have also been referred to as kind of technical indicators. Let's say what we're looking at is unexpected earnings, or what we call earnings surprises, where analysts have predicted earnings to be some X, and where did the actual earnings come in? And the differences between those reported earnings and expected earnings, they're what they call is this earnings surprise or unexpected earnings. So notice down here, your unexpected earnings is your actual earnings that actually happened versus what was expected. Typically, this is kind of a bunch of research analysts. What's the general consensus of what people think the actual, what the earnings were going to be? And when they're different, that is the earnings surprise factor. So another momentum indicator is also based on the relative change in earnings per share. It's called the standardized unexpected earnings, right? So based off of this relative change in earnings per share, you'll notice this should look familiar. Essentially, the earnings surprise versus the volatility of that earnings surprise, right? So what we're looking at is, okay, so the earnings surprise at the top, and then how much variation do we have, standard deviation of that particular surprise. Now, what we've seen is these positive surprises tend to lead to may help to indicate more persistent, positive, abnormal returns into the future. So when we measure kind of this central tendency in multiples, we're looking at things such as the arithmetic mean. This is just the simple average, right? We just take them, we look at the multiples, and we average them. And we have like the harmonic mean, which is less affected by less affected by these large multiples, more by these small outliers. Because in multiples, this can be an extreme problem, right? Like if I'm looking at just in recent times, if I'm looking at, let's say, tech stocks, overall technology stocks, if I look at, let's say, Apple, right? Apple's P/E ratio hovers between essentially 10 and 20. So, let's say around 2. I'm sorry, at around 12. And if you then add in, let's say I start adding in others, like I add in Google, which pretty much comes in, let's say, at around 20 to 25. And then if I take a simple average and I add in Amazon, which basically at some points has has a PE multiple of 800, think about what happens to the arithmetic mean if I just take Apple, Google, and Amazon, right? So if I go 12, 20, 800, Amazon's going to dominate. So harmonic mean helps to manage that situation. Now, weighted harmonic mean takes into account the effect of outlier, but depending on how much it makes up of my portfolio. Now, if I have a lot of values, basically I can just take the median or the middle number. This is least affected by these huge outliers on either side. So the first one is your simple harmonic mean. It reduces the impact for large outliers. May worsen the impact for small outliers. Basically, the small outliers are bounded by 0, so they essentially are less problematic. The most they can go to is essentially 0, whereas a PE ratio can essentially go to infinity theoretically. So, whereas weighting, we less weight on the higher ratios and then more weight on the lower ratios. This kind of removes the effect of, let's say, I have an Amazon in there with 800 PE ratio, which, I mean, these are things that you have to take into account as you're trying to do what? Remember, what we're trying to do is find a PE ratio that is overall comparable to the overall industry. And here's the formula for the harmonic mean. The number of observations, you'll notice at the top, and then the values are 1 over. You add up all of the values, but 1 over the particular observation. So the simple harmonic mean typically is a lower value than the arithmetic mean, unless all the observations are essentially the same value. And used when the market weight information is unavailable, because otherwise your weighted harmonic mean may be a more indicative measure. So let's take a look at the weighted harmonic mean. It's similar to your simple harmonic mean, except we're going to use weightings, because the idea is that if I just simply average PE ratios within the portfolio, I'm not going to get the PE ratio of the portfolio. So just as a kind of a quick example, you'll notice, let's say if I have a stock A, let's say priced at 10, and I stock B priced at 16, and stock A makes me $1 of earnings, and then stock B makes me $2 of earnings. So this is the PE for A and B. Now, PE for A is essentially what? 10? And then PE for B is 8. Now, if I average these two, so what's the average of 10 and 8? It's going to be 9, right? However, if I think it from a, let's say, corresponding to an actual portfolio value standpoint, if I add both stocks together, that equals what? 26 in actual price. It's creating earnings of how much? Basically 3. And this actually equals what if you calculate it out? 8.67. So if I do a simple average of PEs, basically the 10 and the 8, that's not going to equal the price of the entire portfolio versus how much earnings it's actually generating. Now, if you go into the reading, you'll see the formula for weighted harmonic mean. This is factoring in from a portfolio standpoint how we actually get a basically corresponding to a portfolio value as opposed to a simple average, because we're using those market weights. Okay, so keys to the exam here. Think about it. We've gone through a lot of multiples. The idea is the method of comparables versus forecasted fundamentals. What does that mean? So there's one way to get a value in which you think the PE multiple is looking at comparable companies. The other way is actually going through, let's say, like a Gordon growth type model, using the fundamentals to calculate it, and then essentially comparing the two to see if it's overvalued or undervalued. And then there are multiple formulas for PE, price to book, price to sales, price to cash flows. You got to know them all. You got to know the advantages and disadvantages. What are some of the rationales associated with this? And then keep in mind the selection of the multiple, which one to use, what are some of the benefits. Make sure you got the PEG ratio, basically the PE to growth ratio. And then basically the PE using to estimate terminal value. Remember, you go through a dividend discount model, and at the very end you're going to need a terminal value. So you're going to use the PE ratio. And how do you do that? PE times earnings basically gets you what? Price. And you're going to use that in your dividend discount model to discount that terminal value to get your actual value of the firm. Look, level 2 is all about valuation, right? And these are kind of the bread and butter pieces. Now, in basically each one of these aren't actually difficult per se, but it's just a large volume of information when you're talking about how much you actually need to know. I don't think any one of them particularly is overwhelming, but as a whole, it thereby can become overwhelming. Take the time, do a lot of the questions and do a lot of these types of multiple vignettes. That way you kind of get familiar of some of the advantages and disadvantages with that. All right? Good luck. Happy studying. I'll see you guys next class.